Before we begin, quick disclaimer. Nothing in this episode should be considered investment advice. Results discussed have not been independently vetted. Any claims made by the guests have not been verified. The content is for educational purposes only. The views expressed by the guests do not reflect those of the host or the show. Have you ever noticed that the more successful you become, the more investment opportunities seem to find you? At first, it's simple. Max out your retirement accounts. Invest in low-cost index funds. Keep saving. Then suddenly, the conversations change. A colleague tells you about an apartment syndication. A friend swears by self-storage. Another investor is talking about oil and gas, private equity, venture capital, or the latest tax strategy. Every opportunity promises passive income, financial freedom, and higher returns. That's where many intelligent, hardworking professionals make a costly mistake. The biggest threat to wealth building isn't missing the next great investment. It's saying yes to the wrong one. One poor decision, one operator you shouldn't have trusted, one investment you didn't fully understand. That's all it takes to erase years of disciplined saving and investing. Today's conversation isn't about passive real estate. It's about how to think like a professional investor. My guest, Chad Ackerman, spent more than 25 years in corporate America before realizing that depending on a single paycheck wasn't the financial security he thought it was. Since then, he's become a passive real estate investor, co-founded one of the largest communities for passive investors, later acquired by BiggerPockets, and has helped countless investors avoid expensive mistakes before they happen. In this episode, we discuss why the best investors don't chase every opportunity, why learning to say no is one of the most profitable skills you can develop, how to evaluate sponsors instead of marketing brochures, and the framework Chad uses to protect wealth while continuing to grow it. Whether you ever invest in real estate or not, the principles you'll hear today apply to every major financial decision you'll make. Because real wealth isn't built by finding the perfect investment. It's built by consistently avoiding the wrong ones. So let's dive in. Hey guys, welcome to another episode of the Financial Freedom Podcast. From Columbus, Ohio, I have Chad Ackerman. He is a passive real estate investor, educator, and community builder. Really happy to have him on. He helps busy professionals discover how passive real estate investing can build income streams without becoming landlords. Chad, welcome.
Appreciate it. Excited to be on and look forward to the conversation. Thanks for having me in today.
Briefly introduce yourself, and I'm excited to dive into the questions.
I was a career W-2 person, discovered real estate investing after about 25 years of W-2 work. Got into that vein of it feeling a struggle of having all my income flow from one paycheck, one source. I was looking to diversify and find other income streams. Discovered real estate, chased a lot of shiny objects, ended up in the passive side. The first investment I made was a 17-story building in Cleveland, the office space being converted to residential. I went big with what I did first off. I fell in love with it. Ended up moved it all over, invested in real estate. I don't recommend it. It was my plan, not the plan, is what I like to say. I was glad I did it. I don't regret it. It helped me get into the space. In 2020, I formed a company with a group of guys that were LP investors called Left Field Investors. We grew that company as a means of getting like-minded people together to share stories, thoughts, and red flags so we could be better investors. We grew it to over 2,000 people in our community. When we got done with it, BiggerPockets came, courted us, and ended up selling to them. Our community is now called Passive Pockets out on their platform. After that, I helped with the transition, and then I wanted to stay in the space. So I decided to take my expertise with Left Field and being an investor and give back to the community, develop an education to help new LPs figure this space out and introduce them to it. And I always wanted our Left Field legacy to leave behind education to help. There isn't a lot of LP education out there. So I wanted to create some LP education. That's what I'm putting my efforts into these days.
To begin the conversation, this podcast goes back 6 years. We have a lot of real estate investors. Quite frankly, it's not my favorite asset class. We had so many passive investors on the podcast. What do you want listeners to know that's different than what they've already heard?
What I try to spend time on, because it seems like as we did Left Field and we were meeting investors frequently, I'd run into investors that were frustrated because the process didn't work. Like you, this became their non-favorite asset class. And to me, the more I dug in and heard their story, a lot of it was misalignment. that there are many different asset classes that you can invest in syndications, and they all behave differently. Majority of the time, as I talk to somebody to find out where their frustration was, they might be a cash flow investor as their goal, but they were in development jobs that weren't going to cash flow for years. There was alignment issues that I looked around the industry at where education was, and it mostly was coming directly from operators. It wasn't a lot of third party education or communities, and people were finding their way through the communities, but there might not be organized education there. What I found as I looked at the operators is the education that was given was more about how to read their own deal, how to understand their business. It wasn't really helping the LP as much of just understanding how to read a PPM and when K1s should come and those kind of things. So I put effort into almost becoming a coach for LPs to say, before you race into all that, let's pause and let's talk about what your goals are. What's your strategy? What's your investor identity? Let's build a buy box together so that we can really put guardrails on what you're looking at. And the biggest goal I have for an investor is to teach you to be able to say no to something quicker than what you might typically. Because you know this, there's a ton of offerings out there. You get swamped with deals, you lose a lot of your time and energy into things that you really aren't going to end up investing in. So I really put an emphasis on the foundational work and try to teach people how to be better investors before they ever even get into deal analysis.
We have the active crowd, and over the years, real estate is how I got financially free. But quite frankly, real estate these days isn't worth my time. But a lot of people like the active side. And I was talking to my friend and colleague over lunch the other day, and he's like, why do you get into real estate? You don't make much money. It's very capital time intensive. He was talking about like all the doctors are talking about tax advantages. Honestly, you don't see much tax advantages. It's a real pain in the ass dealing with really bad tenants. Now you got storms, insurance. Why can't you just go into equities or a small business?
My answer to that is that sounds like the pure definition of why I like passive investing more than active investing. So I never pulled the trigger on any active real estate. I never got involved in any for all the reasons you just brought up. I didn't want to be a landlord. I didn't want the tenants, the termites, the toilets. I found the passive investing and the tax advantages on the passive side are very different and much more lucrative on the passive side than they are on the active side. I'm not a CPA, so I highly encourage people to go dig into this on their own and find about it. But what I will share with you is the bonus depreciation that I have seen from investing since 2018 has allowed me to show paper loss every year that I've been in this, that I haven't paid tax on anything that I've invested in or received distributions on to this point, which has been 8 years now that has been going on. So I think the tax advantages on the passive side are extremely different than the active side. That's the first place I send investors that are more used to the active to go dig into the tax benefits because they're very different.
Here's the problem that a lot of people are I know what their audience are thinking because when we were on the active side, people are like, get a property manager, but then property manager, they can make your investment even worse. Then people say, go to the passive side. Here's the problem with the passive side. You give up a large chunk of your money and they run away to a island. Or in a lot of physician groups, they listen to these physician influencers and lost a lot of money over the last couple of years. I mean, like, why not just stay with your W-2 and invest in equities?
Yeah, that's fair. There is no right answer here. There's risk involved in any investment that you do anyway. The biggest risk on the passive side to me is the operator. The I'm going to take your money and run. And I'm not going to deny, you can Google this and you'll find scenarios where it's happened. But the percentage of time that happens versus quality operators is very minor. But it's the thing that gets the press. So it becomes the scary object that we have. What I will say, the beauty of the active side or investing in real estate versus equities, or you're at least investing in real assets. At the end of the day, if you invested in an apartment building and it burned to the ground for whatever reason you didn't have insurance, you still have the land you could sell. There's still an out there to some degree that you could recoup some of your money if all else fails. The only real way you lose all money is that operator. My advice for people around the operator, that's the first and foremost thing you need to do from a due diligence standpoint, is you really need to know and trust that operator. I encourage people to get involved in investor communities so they can find background from people that have track records with these individuals. Don't trust the gurus that come and market to groups. Good marketing can really kill an investor's portfolio for sure. Do your own due diligence, dig in, find people that have actually invested with that individual before you invest with them. Make sure you get their story. Make sure you understand what has happened. How have communications been? How's the performance been against the performa? Get real tangible feedback on those individuals before you ever invest a dollar with them. That's always my advice.
A quick question. Are you paying more in taxes than you should? Most high earning physicians overpay by tens of thousands because their CPA only looks backwards, not forward. Health is different. Dedicated CPAs powered by AI that work year round, not just at filing time. Tax strategy and proactive planning for practice owners, investors, and physicians with complex financial lives. Built specifically for professionals who want to keep more of what they earn. To find out more, check out jointgeld.com. That's jointgeld.com. Links are in the show notes below. I think you said it, the mantra in these physician groups, they were saying, okay, do an Airbnb. Oh, do a 1031. Oh, do a bonus depreciation. And there were investors that did that. And it's not as easy as it sounds. Like theoretically, you can, but there are things that you have to be aware of. A lot of these influencers overpromised. The core narrative around this is a lot of doctors worked hard, they save money, they make a lot of money, they can be frugal, they can basically invest in the S&P, NASDAQ. Then along comes these things like passive investing, alternative investment, oil, gas, all these things. And one investment mistake can set them back years versus if they just put it in the S&P and let it sit and ride.
Yeah. A lot of the things I encourage people to do, spread that risk around. If you are enticed to invest in real estate on the passive side, my advice is invest the minimum amounts you can with an operator to start out with. Spread that around. We preach diversity in 3 elements. Diversify by operator, so you don't put all your eggs in one basket. Diversify by asset class. Get in 4 or 5 different asset classes. Don't put everything in multifamily. If housing takes a hit, your whole portfolio takes a hit. Spread it around to different asset classes. And the third thing is geography. Don't buy everything in Atlanta. If Atlanta's economy takes a hit, your whole portfolio takes a hit. Spread around. Diversity is king in this business. Spread it around until you meet people that you know and trust. Then maybe go bigger with them in a second tranche that you do after a period of time. That period of time is very subjective. It might be a year for some. It might be that they need a deal to go full cycle first to really feel comfortable with it. That's very subjective. It's up to the individual. Don't take a big check and dump it into somebody for the very first time. That risk I would never take on myself, especially if my go-to is I'm in a community, I'm in Passive Pockets. If I meet a new operator, I'll go to the forum Passive Pockets. I'll plug in, hey, has anybody ever heard of Chad Ackerman General Partner before? If nobody responds or has any feedback on it, I'll go back to that operator and say, look, nobody in my community's heard of you, so I'm not going to invest with you, but put me on your communications list. Let me follow you for a year. It's not no, never, but it's no, not right now. Let me watch you for a while and see what I think. Maybe that'll change down the road.
I love pointing out different points of views. I don't want this podcast to be the same thing over and over for the audiences. Everyone says multiple income streams. At what point does chasing too many passive income ideas actually reduce wealth?
I think that's a great question. This is another subjective thing. It depends on the profile of the individual. It's my scapegoat answer for you. It's true that for different people, there's different class. Not everybody's going to go liquidate their 401k. I did dump it into real estate. I don't encourage people to do that, but some people find that means available to them. Maybe they're in a W-2. Maybe they have a spouse that has a lot of equities and they can balance their portfolio that way. What I preach at the end of the day is you should have diversity across real estate, equities, whatever the case. Real estate was left field. We called securities right field. You probably ought to play in center field is where you ought to be. What percentage of that mix? That gets subjective of how you want to spread that risk. Where are you in your career? Are you in a growth mode so you can be aggressive? Or are you approaching retirement and you want to secure that? All of those things play a factor in what that mix should be for you.
When I was having lunch with my colleague, even though real estate is painful, it's one of those asset classes that's very slow. You still need it just in case equities don't do well or your business takes a hit. When you say diversify, can diversification become an excuse for avoiding conviction?
That's a fair risk. Absolutely. I preach build a buy box. That buy box could become a crutch for you that gets you out of critical thinking and get you out of taking advantage of a situation that you may have a benefit to. I think there is a risk there. It gets back, do your due diligence, balance, calibrate back to what your goals are, make sure you've got alignment. Hopefully, you're making the right call. At the end of the day, it's guesswork, to be honest. We're trying to make educated guesses. At the end of the day, we're guessing at what's going to pay off for us in the long run.
Everyone says cash flow. Would you rather own an amazing appreciation deal with zero cash flow or something with just like mediocre cash flow forever?
Very subjective. In my portfolio, I like both. I like to have a spread of high cash flow in my portfolio. I've got triple net lease, commercial and industrial deals that cash flow every month, very standard. They've got a 2% increase in rent every year that I can count on. They're my bond that gives me money on a monthly basis. Then I want some equity. I'm 4 years old. I'm still trying to grow wealth here. I want equity out of my deals. So I get into multifamily that are going to have value add that go up. I try to look sparingly, a low percentage on something that might be a big hit, but I don't take a flyer on big hit items very frequently. I go for cash flow mostly because I'm out of my W 2. So I want cash flow coming in. And I look for equity on the side with my projects too. It gets very subjective. Give me 5 years, this may change. And I move to pure cash flow at some point as I'm not trying to grow wealth as much, but protect it and stick it in debt that will cash flow nicely for me and be little risk. It can change, it can pivot. You should be flexible with your strategy. It shouldn't be locked in stone for entirety. Treat it like your will. You're supposed to create your will for what you need today. If something changes, you pivot your will. Your strategic goals for investing should mirror to some degree. Maybe you're thinking further down the road than you would with your will, but figure out what you're needing for your today's scenario. Are you still a physician? You're making a good income. Cash flow isn't as big of a concern for you. Maybe you're more aggressive on the wealth side and the equity side.
We alluded to this. Everybody says passive income, and I'll allude to a conversation I had with my brother-in-law. He was a real estate investor. We're reflecting. People are saying real estate is passive income, but it's not passive income. You're dealing with these issues. Is passive investing actually passive?
From an IRS standpoint, which is what matters at the end of the day, the single family side that you're talking about is active income. The IRS will treat that as active income, tax it as active income. As a limited partner passive investor in syndications, the IRS counts it as passive income. This gets important for tax advantages that you were talking about. The tax advantages I'm getting are against passive income that I'm collecting. They will not offset the active income. There is a differential there. However, the IRS does consider me to be a passive investor, which means I'm a limited partner investor. My active side is me doing due diligence to figure out what deal I want to get into. Once I write the check and sign the P, I become passive and along for the ride. And there's limited things I can do if I don't think the deal's going the way that it should. I don't have that ability to say, hey, GP, I think we ought to do something different. I could say it, but he's not going to do anything about it. There's where the differences is. What I'm doing, the IRS does count this as passive income into my portfolio.
For people that are risk adverse, especially doctors. I had another guest last week. She was saying she never pays attention to the IRR and returns. She focuses on the operator, which you talked about, which is a good sign. And she talked about the holding period. What are things people need to gloss over on marketing brochures? For example, when I was learning about stocks and index funds, a mentor of mine look at the expense ratio. That's the main thing. You want the lowest because that way you're saving.
I wouldn't say ignore the IRR altogether. I will say it's a number that can be manipulated. Don't put all your stock in the IRR. I'll agree with her on that. I wouldn't tell you to ignore any numbers on there because if somebody gives me an IRR of 30%, I'm walking away from that deal right now without even looking at it. It's worth paying attention to. By all means, bet on the jockey, not the horse. So vet the operator first. When you dig in, I like to look at the debt structure. How do they set the loan up? Where am I in the capital stack? I'm getting deep into the weeds, so forgive me if this doesn't hit with the audience, but those are important. Debt to service is very important. How much debt can they cover? What are they going to have to hit? Minimum tenant requirements if it's a multifamily unit. What's their break even point? How many tenants do they have to have? Is it 95%? That's risky. Is it 60%? They could be 60% empty and they'll still meet their numbers. That makes me feel comfortable then. There's different things and get subjective of what is important to one individual. It's changed for me over time. When I started in 2018, it was high level numbers because everybody was hitting home runs because the economy saved you. When COVID hit and interest rates went up, I got smarter about looking at debt structures and understanding, is this a fixed loan? Is it a variable loan? What are your available rates? I like looking at the stress tests that operators put in their PPMs now. So you can understand the metrics that they've run out of, here's worst case, best case scenario, what has to fail, what has to go correct in order to make the deal go through the way they're hoping it goes through. All those become a factor for me. At the end of the day, you want to look at everything. With these days, it feels like you can set up AI to have your benchmark metrics and ranges you're comfortable with. Dump a PPM in and let it run through to give you the quick response of red flag, pass, or fail. That helps a lot. I don't let I pick the deal for you. We aren't there yet. It hasn't happened yet. But I think it can do a lot of due diligence to help you stick to your buy box and identify parameters that are important to you and the ranges that are important to you and have it vetted out for you real quick.
If listeners remember only 3 things from today, what is it that you want them to remember?
First, get educated. Don't trust a guru or a marketer just to tell you this is a good thing to get into or not. Get educated so you can make a good decision around this. Diversity being king would be number 2. Diversify your portfolio in any way, shape, or form you can to spread your risk, maintain and protect as much wealth as you can. I don't think you can ever fall short on that logic. Third thing I would recommend to people, get involved in a community. Find like-minded people to learn off of that are steps ahead of you or very experienced so that you don't have to remake mistakes that other people have made. Those are valuable for any investor, whether it's real estate or the stock market. I think you can find those 3 areas in any space you go to and be better off as an investor.
How can they connect and learn more from you?
To find me, easiest place is my website at chadackermanrealestate.com/start. I've got a starter kit there to teach you more about this space. If it's interesting to you, you can download the starter kit. You can get an idea of what this is all about. If you have more questions, connect with me there, reach out. I'll be happy to talk to you about it.
Excellent. Thanks so much for coming on. Really enjoyed this conversation.
Thank you. I enjoyed it as well. Good stuff.
Let's zoom out. If you're a physician, founder, or high-income professional, and you feel like you're working harder every year, but not structurally freer, you're not alone. The mistake isn't effort, it's architecture. This show exists to help you convert expertise into scalable leverage, faster and with fewer expensive missteps. Here's the diagnostic I mentioned before. If your income requires your constant presence, if your capital isn't compounding outside your profession, if your highest value talent is doing low value tasks, you don't have a growth problem, you have a leverage design problem. And if you want to fix it with clarity instead of guesswork, I offer a limited number of one-on-one leverage strategy sessions each month. We audit your income model, capital deployment, authority positioning, and structural bottlenecks, and design your highest return move. If you're serious about compressing years into months, the link to apply is below.